Hey everybody, I'm Dustin with Focus and Fit Financial. Thanks for swinging in and checking this video out today. Always a lot of discussion about should you pay off your house mortgage or should you just go ahead and keep it for the full term. And when I say pay it off, meaning do you want to pay it off early, 15 years or faster, right? You have some high profile individuals that say, oh, pay that thing off as fast as possible. There's nothing like having security in having your house paid off. That is true. Then you have other professionals on the opposite end of the spectrum that say you should never pay this thing off, never pay this thing off. And then you have some people that are in the middle that kind of say that maybe lean a little bit towards the other side that say, hey, well, if you can end up getting a real low mortgage rate, why don't you just take that money and end up investing it? But there's risk. There's risk in doing it. There's risk in investing it. There's also risk in owning a home. If a bank decide to call the note on you and you couldn't end up getting a mortgage or another loan to be able to pay off the principal that's left, you find yourself in a world of trouble. So there's risks on both ends because otherwise you invest that money, you can end up losing that money and that money was wasted where you could have invested that money into the house on a 15-year fixed note and had that going that way. So I'm just a normal guy, just like you all are. And so I just like to crunch numbers, right? So I'm a financial coach. That's kind of a direction that I'm trying to take and add into a side hustle for me. And so I just like to crunch numbers and let you make your own decision, right? You shouldn't let somebody else tell you what to do, but you may not know how to crunch the numbers. You go, I don't know, what do I do, right? And so that's what I just want to do is these things just kind of bounce around in my head. And so I figured why not go ahead and make a video out of it, show you, might be a little controversy. But if you end up finding that you like this video, go ahead and actually like it. Maybe hit subscribe because I'm going to try to do some more videos throughout the year that might be beneficial to you, that you might find informational. Maybe comment down in the comments. Did you like the video? What could have been done better? And then, of course, maybe share the video to help me grow the viewers. And maybe somebody else is looking at these things in their mind, but they don't know how to run the numbers. So let's go ahead and dive on in and see what we can do. So, gonna go ahead and look down at a house, right? So the median house value, according to Redfin, is around $375,000. So we're gonna go ahead and use a home of about $384,000. Okay, so just a little bit on the higher side. Just looking for something in our area here in Texas, just to try to see if we can find something similar. If we decided to put down 10% on that house of $38,400, that's what we're also looking at for the house. So let's take a look at the 30-year fixed rate first. You have about a 3.25%. Let's say that's what you end up getting for your rate. We go ahead and we plugged it in. I'm using Zillow for my calculator here, my mortgage calculator. So if we put that in, this is on a 15-year fixed. If we end up adjusting this 30-year, it goes, and then we have our mortgage. This changed. I just did this like 10 minutes ago. But anyway, so we'll stick with the numbers I have over on this side of the screen a little bit because this is what it did end up popping out earlier with all the same numbers. It was $22.65 per month is what it came out with, all right? So after 15 years, you'd have a principal remaining of about $214,000, and then interest that you will have paid is right here, the $138,650, okay? So we can look over here at the 15-year fixed rate, all right? That gives you, when I put in those numbers with these values, it gave us a monthly payment of $3,107. That's a difference of $842 per month that you're really looking at between the two. Do you pay it off in 15 years or do you go ahead and drag out the 30 years? Now, with the good thing about the 15 years, after 15 years is done, you have nothing remaining on the principal. Interest paid, look at this. The interest paid is little less than half, right? So $62,000 difference in interest between the 15-year and the 30-year because the way that mortgages are set up is that you pay a lot of your interest up front, right? You pay a lot of that interest up front. So that's why there's so much there. But the interest here is just $76,000 for doing a 15-year fixed rate. So now you got a paid for house and you've paid less money to the bank. All right, so, well, if you have the means to go ahead and take this and put it towards a 15-year fixed rate, and you want to look at that security of owning your own home, and like Dave Ramsey likes to say, if you don't like being out of debt, go ahead and go get another mortgage, right? But so what I want to do is, if you have the means to put that towards your 15-year fixed rate, you can. Or if you have the means to end up investing that, we can. Now, let's go ahead and consider one more thing, okay? Is that a lot of people don't like to talk about a 10 and 12% return. Dave Ramsey talks about that all the time. Well, what real big time investors, you ask big time investors, you watch other YouTube videos of other big time investors, they'll always go ahead and talk about the 8% return. But a real investor doesn't want a 10, 12% return. They want 15, 25, 30% returns. They got to be out there, but it's not the typical ones, right? Because we that are average, we don't find those necessarily. So let's talk about 8% and 10% returns with this $842, okay? So let's just look at that and go from there. Now, I like to use Dave Ramsey's calculator just because it's very simple and it helps us be able to figure out our numbers a lot more easily instead of plugging in all these extra details or whatever. So if we took this $842 per month, now we can't invest anything in the 15-year because we're investing that into the house, okay? So you're not gonna have any money in your pocket after 15 years, but you're gonna have that paid for house, which gives you that some sense of security that you've got, right? And then you can start contributing that monthly note. But let's look at if we still have the means to put that $842 into something and we invested it. Now, in this scenario, if you're gonna use that money to possibly pay off a note and you're not 59 and a half yet, it can't go directly into a 401k or an IRA or something that you have to be 59 and a half for. It's gonna have to go into something like an index fund, an ETF, a mutual fund, something that you can pull out of that's not into a retirement account, okay, if you're gonna pull it out early. So for the purpose of this, we're looking at 15 years from the age of 40 to 55 as where we're starting, okay? So we take that $842 per month, and for this box here, you have to actually start with something in there. So we're gonna start with $100 because it's not a significant amount, right? We invest that $842 per month at an 8% return. That gives us $291,694, okay? Now, if you go back up here, the principal remaining balance was $214,000, right? So we need to pay that off if we decide to keep these things comparing. If we wanna pay off that $214,000, what's gonna happen is you take your 291 minus the 214, but you pull out the 214, you're also gonna have taxes on it, right? You will still pay a capital gains tax on that amount, but there's no penalties for it, okay? There's not an extra 10% penalty because it's not in a retirement account. So if we look over here on the left side, your contributions were $151,000. You're gonna pay capital gains on the gains that you took out of that, right? So over the course of 15 years, right, if you took 842 times 15 years, you put in 151,000. But we need 214,000. So that's a difference of about $63,000, okay? So $63,000. If we want to go ahead and crunch that out, let's just take 214,000 minus 151,000, right? Make sure I carry all my zeros. $63,000 difference. That's your $63,000 in gains of what you're going to take out. Well, we need to go ahead and figure out what capital gains is, right? So capital gains, by the way, let's just say that you are married filing jointly or whatever, you can pull out up to $80,000 before you get into 15%. But if you're single, let's just say that you might be single, you're gonna be at the 15% range because you're pulling out $63,000, but you need to adjust a little bit for taxes. So we're gonna say you're pulling out $225,000, okay? So you're gonna pull out $225,000. But anyway, 15%, multiply that by 15%, and you see that you're gonna need $10,000 extra to pay for your taxes, okay? If you have a 15% capital gains. And 15%, because you're pulling out 63,000, so you have a long ways to go. So we're gonna pull out 225,000 out of this, okay? 225,000 out of this. So that's 291 minus the 225 leaves us to the 67,644, all right? So this is the money that's left in my pocket after we've paid off the house. Not necessarily my pocket, your pocket, right? But that's what you have left. Over here, you don't have that extra money in your pocket. It's all in the house. But we have a paid off house here and a paid off house here. Here we don't have money in our pocket because it's all in the house. Here we do have money in our pocket, right? And we can go back up here and say, well, I paid more in interest here, okay? Money spent is money spent in a sense, all right? We're talking about this $842 difference, right? So both spent money, both paid off a house. There's interest that's already been paid to the bank, but now we're looking at what's in my pocket, what's not in my pocket, and this is in my pocket now. So now we need to go ahead, let's crunch these numbers first, and then we'll come over here. So we now get to start. It's still going to go over the next 15 years. I'm not going to change the ages. We're just going to go ahead and work with these other numbers. 67,644 is what our new starting amount is going to be for another 15 years to figure out what gain we're looking at. But instead of $842 per month now, we're going to be disciplined. We're going to go ahead and fully invest that $33.53. We're still going to get our 8% return. We haven't changed anything different. That's where we get the $1,383,000, right? After 15 additional years, so this is the end of your 30-year mortgage. If you waited to pay off that mortgage for 30 years instead of investing that $842 that you had the means to do, you'd be missing out on this, right? This is what you'd be missing out on. But if you ended up doing the 15-year fixed and you put all the money towards it, all that money towards that 15-year fixed up front, so you could have a security after 15 years and not dink around with all of this, right? You'd still have $1.1 million, right? That's not too far off. It's a difference of $219,000, but you still have that money there. That's on an 8% return, okay? That's the 8% return right there. So you could make your decision from there. If you're wanting to be more conservative and do the 8%, you got it. Look at your numbers. Go run your own. This is just an example, but go run your own numbers and you can see how that happens, right? But let's move down to the 10%. What happens if you decided to do the 10%? Well, if you did the 10% return, you have the $842 per month that you have the means to go ahead and invest. With the 15-year fixed rate, you're still putting on the house. And so after 15 years, the first 15 years is up, you don't have any money in your pocket, okay? But if we invest that $842, we're gonna come back over here. You start investing at $832 at the beginning of the first 15 years. Oops, we gotta start off at the $100, excuse me. How much we're gonna contribute monthly is gonna be that $842, right? And now we got that 10% return. So now we're looking at $349,000, right? So that's what you've got at the end of your first 15 years. Well, you're still gonna have that $214,000 principal that you wanna pay off. You're gonna have to pull out the additional amount to cover your capital gains, $214,000. Still gonna have, you're still gonna pull out about $73,000 to be able to go ahead and take care of that. But it's a total of $225,000 that you're taking out again, right? $225 will pay off the $214. That also covers the taxes. So now the $349 minus the $225 leaves you with the $124,000 that we're looking at right here. So if we take that $124,000 because it's still in our account, right? And this is at the 10% return, right? So it's just a little bit higher than the 10% return. The 8% gave you the $67,000 in your pocket. This one gave you $124,000 in your pocket. So almost double, almost. My math ain't the greatest at that. That's why I'm using these calculators online, right? But we have that $124,000. We go ahead and take the $33.53. Now we're investing that at 10% still, all right? So now we get that $1.9 million down here because we had this 124 to start, and then we invested we were disciplined and invested that full mortgage amount that we had been doing. So after 30 years of investing that $842 per month and then paying off the house at the 15-year point, you still end up with $1.9 million. But if you did the 15-year fixed rate, at the end of the first 15 years, you had a paid-for house, so all you can do is end up starting to invest this. So we come back over here, you still only have that $100 to start, but we're investing that $33.53 for 15 years. You still end up with $1.39 million, right? That's still really good, but it is a difference of $553,000. Both were paid off at the 15-year mark, right? Both were paid off at the 15-year mark. And but at the end of the 30 years of investing that $840 either into a house or into an investment, you end up having this amount here. All right. So those are your numbers that you have. Now, once again, these are just numbers that are crunched. I'm not a financial advisor. I can't tell you what to do. You just got to do what you feel like is going to be best for you, what's best for your family, right? And so that's what we really need to take a look at. And I'd love to help people out. I'm trying to get a side hustle going in the financial coach. direction. So if you have some questions, I'll be able to bounce it around. Hopefully you found this information helpful, but you have to make your own decisions, right? And which way seems like it'd be great, and which way seems like it'd be better fitting. Having a paid-for house is good, but you're also going to find a lot of YouTube videos out there that they talk about never pay off your house, right? You don't want to own your own house. You find plenty of those videos out there too. And it probably goes along with, you're going to invest in your house, or you're going to take that money and you're going to invest it in something, invest it in rental properties. Are all those things fine? Sure, absolutely. I have, before crunching all these numbers, I've in my mind, pay off my house fast as I can. Crunching numbers, it's just something different, right? I didn't know. I had to crunch the numbers to see what difference does it really make, right? What difference does it really make? At the end of 15 years, I could look at it after investing it. I'd go, man, okay, what do I want to do? I'm still having it paid off, but so you just got to make your own decision on which risk that you want to take, and sometimes you have to work with a spouse too, right? So if you're married, you got to work with a spouse. So hopefully you found this information helpful. If you did, please like it. Please subscribe if you can, and maybe share the information. Maybe somebody else is going to be looking for this type of information and just isn't sure how to crunch those numbers. I used Zillow for the mortgage calculator. I used the Dave Ramsey for the investment portion of it, and so. Have a great day, and thanks for tuning in. Hopefully I'll get some more videos out to y'all soon.